In the span of just 3 weeks this summer, we watched literal missiles hit military bases in the Middle East. We saw the Federal Reserve violently threaten to hike interest rates to 4%.
Right.
And we watched a rocket company bleeding, I think it was like $5 billion a year, suddenly become worth more than Amazon. And the stock market's reaction to all of this chaos?
It just brushed it off.
Yeah, it casually hit an all-time record high. So welcome, everyone, to this deep dive. Our mission today is to untangle the incredibly chaotic and, frankly, historic events of June and early July 2026.
And it really is historic.
It is. We are staring down a stack of sources that look like they belong in a history book. We're pulling from market reviews by Vested Finance, on-the-ground news reports from WSLS and iHeartRadio. Plus, we have deep supply chain flow data from logistics management and heavy macroeconomic forecasting from Complete Intelligence and Trading Economics.
Yeah. And when you synthesize that whole stack, it reveals a market that has just completely decoupled from the traditional summer playbook.
Yeah.
You'd expect a quiet summer, but the sheer density of capital moving across borders and sectors right now is staggering. We are basically witnessing a massive structural shift in global finance.
And that structural shift is really the core theme we want to unpack for you today.
Yeah.
We are moving away from this era of blind euphoric hype around artificial intelligence.
Right.
And we're entering a very strict, highly punitive show me the revenue phase. And all of this is happening while a surging U.S. dollar and rapidly shifting geopolitical fault lines are just rewriting the rules of global investing in real time.
They really are.
So we're going to break down what this actually means for you, for your portfolio, and for your understanding of how the global economy is functioning right now, because you just cannot look at a headline anymore and assume you know how the market will react.
No, you really can't. The transmission mechanisms between news and asset prices have fundamentally changed. Old correlations are breaking down. And to understand why they're breaking, we have to look at where the liquidity is actually flowing, not just where the sentiment assumes it should be flowing.
Which means we have to start with the single event that acted like a giant black hole in June. The event that sucked all the oxygen and basically all the available capital out of the markets.
The SpaceX IPO.
Yes, the SpaceX IPO. Let's look at the history that was made on June 12th, 2026. According to the data from Vested Finance and Trading Economics, SpaceX priced their IPO at $135 a share, raising $85.7 billion in a single day.
Unbelievable.
The previous record for an IPO was Saudi Aramco back in 2019, and that was $25.6 billion. SpaceX obliterated the all-time record by $60 billion.
Well, and pulling $85.7 billion of pure cash out of the public markets in one offering, that fundamentally alters the trading landscape. Well, when institutional asset managers and retail investors allocate that much capital to a single new issue, they have to sell other assets to fund it.
Oh, right. They have to get the cash from somewhere.
Exactly. You cannot raise that much capital without creating a massive displacement effect across the rest of the technology sector. That liquidity vacuum is going to become a recurring theme as we look at what happened to semiconductor stocks later in the month.
Yeah, that makes sense. And the valuation is where the math gets truly mind-bending for me. It hit the market at a valuation of $1.75 trillion. And then within days, the stock surged to $225 a share.
Which is just astronomical.
Literally. It briefly pushed SpaceX's market capitalization across the $3 trillion mark. Temporarily, this rocket company was larger than Amazon. It was larger than Microsoft.
Yeah.
And yet, when you look at the S1 filing, the contrast between that $3 trillion valuation and the actual underlying business operations is pretty severe. For 2025, SpaceX reported $18.7 billion in revenue, which is up 33% year over year.
Which is great growth, but...
Right, but that top-line growth is driven entirely by one segment. Starlink. They crossed 10 million Starlink subscribers, making it the only profitable segment in the entire conglomerate.
Yeah, the S1 reveals a company that is essentially two entirely different financial organisms grafted together.
How do you mean?
Well, on one side, you have Starlink, which is a highly scalable, subscription-based telecom business with predictable recurring revenue. The unit economics of launching low Earth orbit satellites and selling terminal subscriptions have finally crossed into profitability.
Okay, and the other side?
The other side is Starship. That's the launch business, the Mars colonization ambition, the deep space infrastructure project, and Starship is a capital incinerator.
A $4.9 billion capital incinerator, to be exact. That's the net loss they took for the year, almost entirely attributed to Starship research and explosive testing.
Right.
And add to that the fact that Elon Musk retains 85.1% voting control of the company. So you have a business losing $5 billion a year with a super voting share structure that gives public investors zero say in corporate governance. Yeah.
Commanding a $3 trillion valuation.
Well, to justify that premium, the market is aggressively discounting cash flows that are decades in the future. Buyers at $225 a share are not valuing the company on its 2025 Starlink revenue.
What are they valuing it on then?
They're pricing in a monopoly on low Earth orbit logistics, point-to-point terrestrial rocket travel, and extraterrestrial infrastructure for the next 40 years.
Wow.
It requires a flawless execution timeline. And the volatility we saw post-IPO is exacerbated by the actual mechanics of the shares available to trade.
And that brings up the index drama that Vested Finance highlighted in their report. So S&P Dow Jones indices looked at this financial structure and rejected SpaceX for inclusion in the S&P 500.
Which makes sense based on their rules.
Right. Their inclusion criteria require 4 consecutive quarters of GAAP profitability. A $5 billion annual loss immediately disqualifies them no matter how large the market cap gets. S&P stuck to their fundamental accounting rules. They maintain the integrity of their methodology. The S&P 500 is historically designed to reflect the profitable core of the American economy, not the most speculative edges of it, regardless of the sheer size of the asset.
But the NASDAQ took the exact opposite route. According to reporting from Fast Company and iHeartRadio, the NASDAQ completely updated its fast-track framework rules.
They basically threw the old rules out.
Yeah, they changed the guidelines to allow a new company to join the NASDAQ 100 index just 15 days after an IPO. They effectively rewrote their historical rulebooks specifically to capture SpaceX, making the inclusion effective on July 7th.
The divergence between the two major index providers highlights a philosophical war in modern finance. I mean, the NASDAQ prioritized market reality and volume.
Right, because it's trading so much.
Exactly. If a company is trading at a $3 trillion valuation and generating immense daily volume, excluding it from a technology index, makes the index unrepresentative of the current market structure. But by changing the rule, the NASDAQ committee triggered an enormous mechanical reaction in the passive investing ecosystem.
Wait, so you're telling me the NASDAQ changed their inclusion rules in 15 days just to capture this one stock? Doesn't that force millions of everyday investors, people who just hold a standard QQQ ETF in their retirement accounts, to blindly buy into a company bleeding $5 billion a year?
Yes.
That sounds incredibly dangerous for everyday portfolio risk.
It forces exactly that behavior, and understanding how that forced buying works is critical. When the NASDAQ announces that SpaceX will be added to the NASDAQ 100 on July 7th, every passive index fund ETF and institutional tracker that benchmarks against the NASDAQ 100 must immediately adjust their portfolios.
They have to match it.
Right. They have to mirror the new index weightings. They have a fiduciary duty to track the index with zero tracking error. J.P. Morgan estimated that this single inclusion event created $4.3 billion in automatic forced institutional buying.
So the portfolio managers running those passive funds don't get to look at the S1. They don't get to evaluate the $4.9 billion loss or the fact that Elon Musk has total voting control.
Not at all.
The index committee makes the decision, and the funds just act like a giant blindfolded vacuum cleaner, just turning on and sucking up the shares at whatever the market price happens to be on that specific date.
The fundamental analysis is completely removed from the transaction. The buying is executed by algorithms programmed to minimize slippage, often utilizing market-on-close orders, to ensure they capture the exact price at the moment the index rebalances.
Right.
And this forced buying collides violently with the reality of SpaceX's float-adjusted market cap.
Let's dig into that float adjustment, because Morningstar did a deep analysis on this. How does the float fundamentally distort the price when that $4.3 billion of forced buying hits the market?
So the term float refers to the actual number of shares freely available to be traded by the public on the open market. While SpaceX reached a headline valuation of $3 trillion, you have to subtract the shares that are locked up.
Okay, like insider shares.
Yes, exactly. Elon Musk owns roughly 49% of the equity. You have early venture capital investors, private equity, and employee-restricted stock units that are all subject to standard post-IPO lockup periods, usually 90 to 180 days.
Meaning those insiders cannot legally sell a single share to the index funds trying to buy them?
Precisely. The actual public float, the pool of shares swimming in the open market, is a tiny fraction of the total outstanding shares.
Oh, wow.
So when $4.3 billion of price-insensitive forced institutional capital enters the market demanding SpaceX stock, and there's a severely constrained supply of available shares, the price action becomes incredibly violent.
Because everyone's fighting for the same few shares.
Right. It ceases to be an accurate reflection of discounted future cash flows and simply becomes a reflection of liquidity mechanics. You have an immovable wall of money chasing an artificially small pool of equity.
Which explains the surge to $225 a share. It isn't necessarily that millions of people suddenly thought the fundamentals of Starlink improved overnight. It's that the plumbing of the financial system forced capital through a very narrow pipe.
Yes.
And if you hold a standard tech ETF, you are suddenly a SpaceX shareholder. You are funding Starship R&D, and you are exposed to the extreme volatility of a stock where the price is currently dictated by mechanical index inclusion rules rather than traditional price discovery.
And Morningstar also warned that as those lockup periods expire over the next 6 months, millions of newly unrestricted shares will flood the market.
Right, the lockups end.
Exactly. The float will normalize, which means the supply constraint will lift. If that wall of passive demand has already been filled, the sudden increase in supply could put immense downward pressure on the stock later this year.
Now, you mentioned earlier that the $85.7 billion sucked into the SpaceX IPO had a displacement effect on the rest of the market. And that takes us directly into the violent turbulence we saw in the AI semiconductor space.
Yeah, the air really came out of that balloon.
The technology sector that carried the entire U.S. stock market through 2024 and 2025 suddenly cracked in late June. We are moving from a pure hype environment to an incredibly strict proving ground.
The market's tolerance for narrative-driven valuations evaporated almost overnight.
According to the Vested Finance Market Review, the back half of June brought a sharp, terrifying correction to the absolute darlings of the AI trade. NVIDIA fell 16% from its Juneteenth highs.
That's a massive move for a company that size.
Broadcom fell 14%.
Yeah.
The SOXX semiconductor index had previously surged 230% in just 14 months. And then Bank of America released a note on June 23rd warning about rate hike risks and questioning the sustainability of the massive capital expenditures pouring into AI data centers.
Right.
Then OpenAI reportedly decided to delay its own highly anticipated IPO all the way to 2027. Suddenly, everyone started questioning if the AI supercycle was running out of steam.
Well, when an index runs up 230% in just over a year, perfection is fully priced into the equity. The multiple expansion assumes that every major technology company will continue to double their capital expenditures on AI infrastructure indefinitely.
Indefinitely.
Yeah. The Bank of America note introduced a crucial psychological pivot. What happens if the hyperscalers, the Amazons, Googles, and Microsofts, decide they have bought enough GPUs for now?
That fear sent shockwaves through the market. But then we get the countersignal on June 25th. Micron Technology released their Q3 earnings, and the numbers shattered every expectation.
They were incredible.
Revenue hit $41.46 billion. That is a 346% year-over-year increase for a massive established hardware company. Their adjusted earnings per share came in at $25.11, and they guided for roughly $50 billion in Q4, which was more than double what Wall Street analysts had estimated.
Double.
The stock surged 18.4% in a single day, crossing a $1.4 trillion market cap before pulling back about 6.7% to profit-taking.
The Micron report is the physical proof of the infrastructure build-out. To understand that 346% revenue jump, you have to look at high bandwidth memory, or HEM.
Okay, what is that?
Well, NVIDIA's GPUs are the engines of artificial intelligence processing. But those engines require massive amounts of extremely fast memory to function. Micron essentially has a sold-out pipeline for their most advanced HBM chips through 2026.
So they can't even make them fast enough.
Exactly. The hyperscalers are taking every chip Micron can manufacture right off the assembly line.
I look at this AI infrastructure build-out, and everyone compares it to the 1849 gold rush. You know the old cliche about buying the companies making the pickaxes. But I think a much better comparison is the late 1990s telecom fiber optic boom.
Oh, that's an interesting parallel.
Right. We spent hundreds of billions of dollars laying millions of miles of dark fiber across the country. The physical infrastructure was absolutely real, and it eventually powered the entire modern internet. But the initial valuations of those telecom companies collapsed because they laid the fiber years before the software applications like YouTube or Netflix were actually invented to monetize all that bandwidth. Are we doing the same thing with AI? Building out trillion-dollar data centers before we actually have the software to generate a return on that investment?
The telecom fiber analogy is incredibly apt for this moment. The current phase of the AI boom is entirely focused on training compute.
Training compute. Okay.
Yeah, these companies are buying tens of thousands of NVIDIA GPUs and Micron memory modules simply to train the foundational models. That requires an astronomical amount of upfront capital expenditure.
Right.
The next phase has to be inference compute, actually using those trained models to generate revenue from end users, whether that is enterprise software automation or consumer applications. The market panic in late June was a sudden realization that the transition from training to inference might take longer and be less immediately profitable than the hardware valuations imply.
But look at the actual dollars being deployed. TeraWulf, a company known for Bitcoin mining, surged 7.9% after announcing a total pivot away from crypto. They signed a $19 billion 20-year data center deal in Kentucky with Anthropic to provide high-performance computing centers for AI.
That's a huge shift.
Right. And South Korea's SK Hynix is preparing a $28 billion U.S. ADR issuance to fund more memory chip expansion. And Broadcom jumped 4.3% on July 6 after securing a long-term silicon deal with Apple.
Yeah, the deals are happening.
Doesn't this tangible, binding corporate money completely invalidate the idea that we're building out too fast? I mean, $19 billion from Anthropic is not a speculative projection. It is a binding contract.
The capital formation is undeniable, but it reveals a shifting bottleneck. TeraWulf is the perfect example. Why is an AI company like Anthropic signing a $19 billion deal with a former Bitcoin miner?
That's a good question.
Because the bottleneck for artificial intelligence is no longer just securing the silicon chips, it is securing the power grid.
The electricity.
Right. AI data centers require a continuous, immense base load of electricity that renewable energy sources like wind and solar struggle to provide reliably. Bitcoin miners already possess the prime real estate with established high-capacity power purchase agreements and heavy-duty electrical substations connected directly to nuclear or hydropower plants.
Wait, so Anthropic isn't buying TeraWulf's Bitcoin mining rigs. They are buying their immediate access to the electrical grid.
Exactly that. The infrastructure spend is real, which is why the underlying businesses are thriving. But the 16% drop in NVIDIA and the subsequent profit-taking in Micron point to a market that is demanding a risk premium again.
Right, they want a discount for the uncertainty.
Yeah, as the Complete Intelligence CI Markets Forecast noted, mega-cap tech stocks are entering a healthy consolidation phase. Investors are recognizing that while the $19 billion deals are real, the cost of funding those deals is becoming exceptionally high.
Which brings us perfectly to the core trigger of that late June anxiety. It wasn't just the fear of overbuilding, it was a sudden, harsh realization about the cost of capital. The billions of dollars needed by SK Hynix, by Anthropic, by the hyperscalers, that money is not getting cheaper anytime soon.
Not at all.
The macroeconomic tectonic plates shifted drastically during the Federal Open Market Committee meeting on June 16th and 17th.
This is the first FOMC meeting under the new chairman, Kevin Warsh, and it marked a definitive end to an entire era of central bank philosophy.
Going into the meeting, nobody expected a rate change, and they held the benchmark interest rate steady at 3.50 to 3.75%. But the accompanying policy statement was a massive shock to the financial system.
It really caught people off guard.
According to the Vested Finance Review, the Fed formally removed its easing bias. They explicitly deleted the forward-looking language that suggested rate cuts were on the horizon, and then the dot plot completely upended the market's assumptions.
And you have to understand, the dot plot has been the primary communication tool for the Fed for over a decade. It allows market participants to see exactly where each individual Fed governor expects interest rates to be at the end of the year.
Well, the median projection from the participants suddenly showed at least one rate hike for 2026. Not a delay in cuts, but a full reversal to a hike.
A huge pivot.
9 out of the 18 participants projected the terminal rate to be at or above 4.00% by the end of the year. But the most stunning detail from the release was that Chairman Warsh himself intentionally opted out of the projection exercise. He did not submit a dot.
The decision by a sitting Federal Reserve chairman to withhold his own projection from the dot plot is an incredibly aggressive communication tactic. It was a deliberate destruction of forward guidance.
Why would a central bank intentionally destroy its own forward guidance? For years, the Fed's whole playbook has been about holding Wall Street's hand right, telegraphing every single move months in advance so there are no market temper tantrums. By withholding his dot, isn't Warsh just injecting unnecessary chaos into the bond market?
He is injecting uncertainty, but he views that uncertainty as highly necessary. The previous regime utilized forward guidance to artificially suppress market volatility.
Okay.
The problem with holding the market's hand is that investors become complacent. If Wall Street knows exactly what the Fed is going to do for the next 12 months, they can leverage their portfolios to the absolute maximum without fear of a sudden shift in the cost of capital.
I see.
Warsh believes that this predictable forward guidance is what created the asset bubbles and the sticky inflation in the first place.
It's like draining the water out of a public swimming pool to see who is swimming without a swimsuit, except Warsh is refusing to give anyone a schedule of when the drainage is going to happen.
That is a highly accurate mechanical comparison. By removing the easing bias, threatening a rate hike, and refusing to plot his own projection, Warsh is reintroducing market discipline.
He's making them manage risk again.
Yes, he is forcing portfolio managers to price in tail risk. He announced the formation of 5 specific task forces designed to overhaul the Fed's communication strategy, their balance sheet management, their inflation modeling, and the future viability of the dot plot itself.
The bond market's reaction to this new discipline was instantaneous. The 2-year Treasury yield, which is the instrument most sensitive to short-term Fed policy expectations, spiked 16 basis points in a single trading session.
That's huge.
That is the largest single-day jump in the 2-year yield since March of 2008, closing out the month hovering around 4.0%. The bond market was completely caught off guard by the threat of a 4% terminal rate.
The violent repricing in the 2-year Treasury reflects a rapid unwinding of leveraged bets that were counting on a declining cost of capital. But the data unequivocally forced Warsh's hand.
Oh.
He could not justify an easing bias given the macroeconomic backdrop.
Yeah, the inflation metrics are incredibly stubborn right now. We saw the May CPI inflation print come in at 3.8% year over year. Core PCE held at 3.4% year over year, and headline PCE actually accelerated to 4.1%, reaching its highest level since 2023.
Right.
At the same time, Q1 GDP was revised upward to 2.1%. You have a U.S. economy that refuses to slow down, generating a persistent stagflationary pulse of elevated prices.
When growth remains positive but inflation accelerates, a central bank has very few options. But the most significant factor affecting global markets isn't just the interest rate itself.
What is it?
It is the structural liquidity squeeze caused by the Fed's balance sheet reduction, often referred to as quantitative tightening.
Complete Intelligence highlighted this liquidity squeeze in their analysis. Can we break down the actual mechanics of this? How does the Fed shrinking its balance sheet turn the U.S. dollar into a global wrecking ball?
Sure. During quantitative tightening, the Federal Reserve allows the Treasury bonds and mortgage-backed securities it holds to mature without reinvesting the proceeds. When a bond matures, the U.S. Treasury pays the Fed.
Okay.
The Fed takes those dollars and essentially extinguishes them from the financial system. They are actively deleting currency from circulation.
So the sheer supply of U.S. dollars in the global banking system is shrinking.
Yes. The supply of dollars is decreasing at the exact moment that global demand for capital to build out $19 billion AI data centers to restructure supply chains to fund geopolitical defense is surging.
Supply and demand.
Exactly. When supply falls and demand rises, the price of the asset skyrockets. In this case, the asset is the U.S. dollar. A structurally scarce, high-yielding U.S. dollar acts as a wrecking ball because it aggressively pulls capital away from foreign markets and emerging economies.
Which takes us directly into the massive global ripples caused by this Fed pivot. The currency markets are the immediate transmission mechanism for U.S. monetary policy, and the impact over the July 4th weekend in Japan was historic.
Truly historic.
Because the Federal Reserve is pushing yields toward 4%, while the Bank of Japan has historically maintained interest rates near zero, the yield gap between the two countries is massive.
Capital is fluid, and it will relentlessly flow toward the highest risk-adjusted yield. When an investor can earn a 4.0% risk-free return in U.S. Treasuries versus near zero in Japanese government bonds, they sell their yen, convert it to dollars, and buy the U.S. debt.
Makes total sense.
This continuous selling pressure caused the Japanese yen to breach critical multi-decade support levels against the dollar.
But the bizarre twist, as CI Markets pointed out in their weekly outlook, is that this currency collapse is actually fueling a massive rally in the Japanese stock market.
Right.
The Nikkei 225 index pushed aggressively toward the 7,500 level. If the U.S. dollar collapsed, the S&P 500 would likely experience severe panic. Why does a collapsing yen cause the Japanese stock market to hit record highs?
It creates a phenomenon known as an earnings mirage, heavily driven by the mechanics of repatriation.
Repatriation.
Yes. The Nikkei 225 is dominated by massive, globally integrated export companies. Automakers like Toyota Electronics, manufacturers like Sony. These companies manufacture their products primarily in Japan, incurring costs in weak yen.
Okay.
They then export these cars and electronics to the United States, selling them for strong U.S. dollars.
So their profit margins absolutely explode when they bring that money home.
Exactly. When they convert those strong dollar revenues back into depreciated yen on their quarterly balance sheets, their domestic earnings look spectacular.
Wow.
The weak currency makes Japanese goods incredibly competitive on the global market, while artificially inflating corporate profits at home. The financial markets are bidding up the Nikkei to capture that foreign exchange arbitrage, completely looking past the domestic inflationary pain a weak currency causes for the average Japanese consumer importing food and energy.
That dynamic is a perfect example of financial markets ruthlessly pricing in the mechanical reality of currency flow over the localized headline pain. And we saw an even more extreme version of this ruthless calculation play out in the Middle East.
Oh, definitely.
Let's look at the timeline of the geopolitical escalation. On June 17th, the U.S. and Iran signed the Islamabad Memorandum of Understanding. This was designed as a 60-day extension of a fragile ceasefire, specifically aiming to keep the Strait of Hormuz open for commercial shipping.
The agreement was an attempt to install a diplomatic framework over a highly volatile, kinetic reality.
And that framework collapsed within days. On June 25th, an Iranian Revolutionary Guard drone attacked a commercial cargo ship, the Ever Lovely. Then, over the weekend of June 27th and 28th, the U.S. launched targeted strikes on Iran, resulting in immediate Iranian retaliation.
Right.
Literal ballistic missiles were fired at U.S. military bases in Kuwait and Bahrain.
A direct multinational kinetic escalation involving major oil-producing nations. By every traditional metric of geopolitical risk modeling, this event should have triggered a massive spike in global energy prices.
But the global oil market completely ignored the explosions. Brent crude oil actually fell during this escalation, ending June down around $71.79 a barrel.
It's wild to think about.
And simultaneously, OPEC Plus announced they were going to proceed with an output increase, bringing an additional 188,000 barrels a day online starting in August. How does a financial algorithm, or a human commodities trader for that matter, look at missiles hitting U.S. bases near the most critical oil choke point on Earth and decide to sell crude oil down to $71?
Because the commodities market has evolved over the last 3 years to aggressively discount headline risk in favor of real-time physical tracking data, the logistics insight from the Kepler Maritime data provides the exact mechanism for this price action.
What does the data show?
Traders are no longer reacting to CNN breaking news alerts. Their algorithms are directly integrated with the Automatic Identification System, or AIS transponders, on the actual oil tankers.
So they are watching the physical boats move on a digital map in real time?
Yes. During the peak of the missile exchanges over that weekend, the AIS data showed that tanker traffic through the Strait of Hormuz never paused. Kepler tracked 28 massive vessel transits on Saturday and 22 transits on Sunday.
50
oil tankers carrying millions of barrels of crude sailed directly through the conflict zone without interruption.
The physical market called the geopolitical bluff. The paper futures market, the traders in Chicago and London, only care if the physical flow of the commodity is disrupted. If the boats keep moving, the supply is reaching the refineries in Europe and Asia, and the risk premium evaporates instantly.
Furthermore, the paper market is heavily influenced by the macroeconomic data coming out of China.
Right.
With Chinese industrial demand perceived to be softening, the baseline requirement for crude is lower. When you combine steady physical supply through the strait with weakening Asian demand, the mathematical output for the oil price is down regardless of the kinetic warfare happening onshore.
For anyone listening and managing their own investments, this is the ultimate lesson in identifying signal versus noise. You cannot protect a portfolio from inflation by trading on a scary geopolitical alert. You have to understand the difference between a threatened supply chain and an actively severed supply chain. If the Strait of Hormuz actually closes and those 50 ships stop moving, that $71 barrel of oil goes to $150 in an hour, and Chairman Warsh's inflation battle becomes an unsolvable nightmare. But until the boats stop, the market will ignore the missiles.
It is a ruthless, highly efficient pricing mechanism that relies entirely on verified physical realities rather than emotional speculation.
That focus on physical reality and underlying fundamentals brings us to the final major theme of our deep dive. We have spent an hour dissecting space rockets, AI, multiple expansions, aggressive central bank pivots, and Middle Eastern missile strikes.
Been a busy month.
All of these flashy, volatile headlines dominated the financial media. But beneath the chaos, the quiet, fundamentally driven sectors of the U.S. economy were executing a massive structural rotation and hitting record highs.
The transition from narrative-driven tech valuations to cash flow-driven legacy businesses was a defining characteristic of the broader economy in late June.
Let's break down the data from Charles Schwab and the Vested Finance Review. The market experienced a powerful rotation into value stocks and small caps. The Russell 2000, which tracks 2,000 smaller domestic companies, gained 3.6% in June alone, finalizing its best first half of the year since 1991.
That's a huge shift in leadership.
Simultaneously, the Dow Jones Industrial Average, the oldest, most traditional gauge of American industry, hit an all-time record high of 53,056.
The capital that flowed out of the semiconductor space during that late June correction did not move to cash. It rotated directly into industrials, financials, and healthcare components of the Dow and the Russell.
And we saw a wave of aggressive corporate restructuring among these legacy giants as they adapted to this new environment. Alphabet replaced Verizon in the Dow Jones, signaling a massive shift in how the index views communication services.
Right.
Comcast announced a highly complex tax-free spinoff of NBC Universal, effectively separating its high-margin broadband infrastructure from its theme park and television network assets. Honeywell completed a massive three-way separation. Even Rocket Lab, operating in the aerospace sector, acquired Iridium for $8 billion to vertically integrate their satellite communications and mount a direct challenge to Starlink.
The financial engineering behind these spin-offs is entirely driven by the cost of capital environment Warsh is establishing. In a world of 0% interest rates, large conglomerate structures made sense because cheap debt allowed companies to cross-subsidize underperforming divisions.
But not anymore.
No, in a 4% terminal rate environment, pure-play operational efficiency is mandatory.
So by spinning off NBC Universal, Comcast is forcing the market to value its broadband utility cash flows separately from its media assets, effectively utilizing a sum-of-the-parts valuation model to unlock shareholder value.
Precisely. They are trimming excess organizational weight to ensure their margins remain robust despite higher borrowing costs. And the macroeconomic data indicates that this focus on operational resilience is working across the broader economy.
The ISM Services PMI data from Logistics Management confirms that resilience. The services sector, which encompasses everything from restaurants to healthcare to financial services, represents the vast majority of U.S. economic output.
It's the engine of the economy.
The index came in at 54, marking the 24th consecutive month of expansion. Anything over 50 indicates growth. So 2 solid years of continuous expansion is a formidable track record. But the most critical detail was the prices subindex.
The prices subindex tracks the input costs that purchasing managers are paying on the ground. It is a highly accurate, real-time leading indicator for broader inflation.
Well, that subindex fell sharply, dropping from the 70s down to 67.7. The purchasing managers surveyed explicitly noted that while they're dealing with localized supply chain disruptions like elevated diesel costs and increased prices for packaging resins due to the Middle East tensions, they are actively managing those costs.
Which is key.
The supply chains are bending, but they are not breaking.
The corporate sector has spent the last 3 years structurally adapting to geopolitical friction. They are no longer operating on ultra-fragile, just-in-time inventory models that shatter at the first sign of a tariff or a delayed cargo ship.
But I look at the Russell 2000, and the math still seems contradictory. Small-cap companies typically carry a significant amount of floating-rate debt, meaning their interest payments go up dynamically as the Fed hikes rates.
Right, they were very sensitive to rates.
If Chairman Warsh just eliminated the easing bias and locked in a higher-for-longer 4% rate environment, those floating rate interest payments are going to remain incredibly punitive. How are these heavily indebted smaller companies managing to post their best performance since 1991 under that kind of pressure?
You are identifying the exact vulnerability that kept the Russell 2000 suppressed for much of 2024. The debt servicing costs are indeed elevated. However, you have to measure that debt burden against the actual revenue generation. The Charles Schwab data highlighted a broadening of the earnings rally. Q2 S&P 500 earnings growth was projected at a remarkably strong 23.3%. The macroeconomic engine, driven by persistent consumer spending in the services sector and continuous hiring, is running hot enough to generate the cash flow required to outpace the drag of high interest rates.
They are simply out-earning their debt obligations.
Yes. Furthermore, the portfolios actively leaning into structural macro themes are thriving. Themes like deglobalization and increased defense spending are highly profitable right now.
Let's expand on deglobalization because for years that was considered a massive headwind for corporate margins.
It was a headwind during the transition phase. But companies have now accepted localized supply chains, tariffs, and geopolitical redundancy as permanent structural features of the global economy.
They've adapted.
They are building new manufacturing facilities closer to their end consumers, onshoring and nearshoring. While this costs more upfront, it guarantees supply chain resilience. They have subsequently priced these structural changes into their end products, passing the costs to a consumer base that so far remains willing and employed enough to pay them.
Interesting.
The margin compression that Wall Street feared from deglobalization has largely been offset by robust pricing power.
The ultimate takeaway for anyone navigating this market is the undeniable mathematical power of diversification. In late June, when portfolios heavily concentrated in a single semiconductor narrative were experiencing severe drawdowns, the broader market was actively rotating.
Exactly.
A portfolio allocated across industrials, healthcare, small cap value, and defense was quietly hitting historical highs. The market rewarded tangible cash flows and physical operational resilience over speculative hardware multiples.
It is a profound validation that sustainable risk-adjusted returns in a high-rate environment require exposure to the entirety of the economic engine, not just the most technologically advanced components of it.
We have covered an immense amount of ground today, navigating one of the most mechanically complex months in modern financial history. Let's trace the arc of the structural shift we just witnessed.
The architecture of the market has undeniably changed.
We began in the liquidity vacuum of the $85.7 billion SpaceX IPO, examining how a $3 trillion valuation collided with a constrained float and the mechanical realities of forced index buying. We moved through the violent proving grounds of the AI semiconductor trade, contrasting NVIDIA's rate-driven consolidation against Micron's massive 346% revenue surge fueled by physical infrastructure demands.
We observed the abrupt end of central bank forward guidance.
Chairman Warsh permanently altered the macroeconomic landscape, opting out of the dot plot, eliminating the easing bias, and accepting the reality of sticky 3.8% inflation, which sent the two-year yield surging and unleashed the U.S. dollar as a global wrecking ball.
Right.
We watched that dollar decimate the Japanese yen while artificially inflating the Nikkei. And we saw physical oil tankers ignore ballistic missiles in the Middle East, proving that real-time logistics data has superseded geopolitical headline risk. And finally, we found a domestic economy anchored by the services sector and small-cap value stocks out-earning its expensive debt and hitting record highs through sheer operational resilience.
It is an environment that severely punishes emotional trading and heavily rewards an understanding of underlying financial plumbing, supply chain logistics, and strict fundamental valuation.
As we conclude this deep dive, I want to leave you with a final provocative mechanism to consider, circling back to our initial discussion of the SpaceX IPO and the NASDAQ. We talked about how the NASDAQ updated its fast-track framework rules in just 15 days to absorb a company bleeding $5 billion a year, triggering $4.3 billion in blind forced institutional buying.
The implications of that single rule change extend far beyond one aerospace company.
Exactly. I want you to consider what happens to the core function of the stock market if this behavior becomes the standard. The market exists to facilitate price discovery, to efficiently allocate capital to the most fundamentally sound businesses based on revenue, profit, and risk. But if major index committees are willing to override their own historical seasoning rules simply to capture the market capitalization of a popular, heavily hyped stock, does actual price discovery still exist?
It suggests a transition towards systemic index engineering, where the committee dictates the valuation rather than the fundamentals.
If trillions of dollars in passive 401k and retirement capital are programmatically forced by algorithms to blindly buy whatever a committee adds to an index, regardless of the underlying accounting or the size of the available float, we may have inadvertently broken the most critical mechanism of free market capitalism. We are no longer valuing companies based on their discounted future cash flows. We are valuing them based on their proximity to the blindfolded vacuum cleaner of passive index inclusion. If the rules of the index can be rewritten overnight, the safety of passive investing might be the biggest illusion in modern finance.
That's a fascinating and, frankly, terrifying point to end on.
Keep questioning the mechanics behind the headlines. Always look for the physical flow of capital and commodities beneath the daily noise and assume that the old rules of the summer lull are permanently broken. Thank you for joining us on this deep dive into the structural shifts of 2026. We will see you next time.